That is the number on your phone screen on a Sunday night, and you are sitting on the edge of your bed.
The room is not fully dark yet, and the refrigerator is running in the other room, and you can hear it from here.
You checked the app almost by accident. You were looking for something else, and the number just appeared. White digits on a white background. Now you are holding the phone at arm's length like that will change what it says. But it will not. 524 is not a number anyone ever taught you how to read or what it actually means for your life.
You know it is not good. You know it's the kind of number people lower their voices about when it comes up.
But nobody ever sat you down and told you what it actually does, what it costs in real dollars on real days. Your father told you to pay cash for everything, and he meant well. He was trying to protect you from debt. He was trying to protect you from the trap he watched his own parents fall into, and that intention was real. What he did not know, what nobody told him either, is that paying cash for everything made you invisible to lenders. And invisible people pay more, not because they are irresponsible, but because the system has no record of who they are. Here is what $524 looks like in practice. When you walk into the real world with that number behind your name, you need a car. Not a nice car, just something reliable with low miles that will get you to work without breaking down. You find a used Civic with a clean title and one previous owner, priced at $20,000, and it looks fine. You walk into the dealership on a Saturday morning, and a man in a blue shirt with a laminated badge shakes your hand. He takes you to a small office with a whiteboard and a printer, he runs your credit, and then he comes back smiling. His eyes are doing something different than his mouth, and he quotes you a rate of 18%, and you sign. You sign because you need the car, and because the monthly payment of $487 is technically within your budget. You drive home in your Civic and you feel like an adult. You feel like you did something real and permanent and yours. The smell of that car is still in your nose when you get back to your apartment, the one where you paid 2 months up front. 2 months deposit, $2,800, because the landlord pulled your report and came back with a number and a face that had already decided. The person in apartment 3B paid $1,400, which is the standard deposit, which is the only deposit. If your number is different, you paid twice as much to live in the same building, on the same floor, with the same view of the parking lot. At no point did anyone explain that a 3-digit number was the reason. It just felt like life being expensive, the way it always does. This is where most people stop asking. They accept the math as the math and work a little harder and cut a little somewhere. But there is a version of this story where the car costs $146 less every single month for 5 years, where the deposit is half, where the apartment and the loan and the credit card all operate on a completely different set of rules. Not because of luck and not because of income, but because of a number. One number that nobody taught you how to read. Every interest rate is a tax on a number you never studied for, and the tuition is collected every single month without a receipt. The average person your age, somewhere in their late 20s or early 30s, has a FICO score of 689. Not 800, not exceptional. Not the kind of number that unlocks the best terms on anything you are likely to apply for. 689 sits right in the middle of the fair to good corridor, far enough from the floor to qualify for most things, but close enough to the ceiling to still be paying a surcharge on all of them, quietly, every month, without a line item that names it. You probably know your score is somewhere around there, maybe lower, maybe slightly higher, and you check it the way you check the weather. What you probably do not know is what the gap between where you are and where the rates change actually costs in real dollars.
Not in points, not in tiers, not in abstract financial language, but in dollars across a car and an apartment and a credit card and eventually a house. Devin works in the cube next to yours. Same job, same salary more or less, and he pays $291 a month for his car.
You found this out by accident, the way you find out most uncomfortable financial information, through a conversation that started about something else entirely. You pay $487. And the cars are different makes, yes, and his was slightly cheaper, but the gap isn't the car.
The gap is the rate. His was 6.5% and yours was 18%. And that difference was assigned before you sat down. Over 60 months, that one number means you will pay roughly $8,760 more than he does for transportation. Not because you chose wrong, not because you were reckless, but because your score was lower when you walked in, and nobody showed you the math. What most people do not know is where Devin's score came from. And the answer is not discipline, and it is not income, and it is not luck. He has a credit card he has never fully paid off. He's not exceptional with money, and he does not think of himself as strategic. What he has is a card he opened when he was 19, a $500 limit on a store card he barely used, and he never closed it. That card is now 13 years old. 13 years of on-time minimums and low balances and nothing dramatic, and lenders read that as evidence of character. Which sounds almost philosophical until you realize it is costing you almost $9,000 extra on a car you bought at the same dealership. Your oldest account is not just a card. It is a timestamp that lenders use to decide how long you can be trusted with their money. The low 600s are almost more dangerous than the 500s, because in the 500s, you know something is wrong, and you feel it. At 580 or 610 or 630, everything is technically a yes. The loan is approved, the apartment goes through, the credit card arrives. But the yes comes with terms that nobody reads aloud during the handshake, and the difference lives in the fine print you signed without reading. Say you were carrying a credit card balance of $4,200. Not reckless, just a number that built up over a few real months. A car repair, a medical bill, a flight home, the kind of expenses that do not feel like decisions, but end up on a statement anyway. If your credit sits in the fair range, your rate might be somewhere around 27 or 28%, and you are paying roughly $98 a month in interest. Not paying down the balance, just covering the cost of having had the balance at all. $98 a month disappearing before the principal moves. Pull that score into the good range, a 720, something achievable in 12 to 18 months of deliberate, boring behavior, and that same balance costs less. The rate drops to somewhere around 20 to 21%, and the monthly interest falls to $71, which is $27 a month gone. $324 a year. That evaporates, not into anything useful, but into the gap between two scores on the same scale. The gap is not dramatic enough to feel dramatic. It does not feel like a robbery. It feels like a slightly expensive month. And that is the problem. Slightly expensive months stacked across years, across a car loan and an apartment deposit and a credit card and eventually a mortgage, are not slightly expensive. They are a significant portion of your financial life, paid out in a premium you never agreed to and never fully understood you were paying. The penalty for not knowing is not paid once. It is deducted every single month for as long as the number stays where it is. There is probably a version of Marcus in your life. Someone who bought a house a couple of years ago and you thought he got lucky with rates.
Marcus went in with a 763, and his monthly payment on a house in your neighborhood is priced at a rate you have not been quoted yet. He told you once, without framing it as advice, that when he was 24, his mother lost her job and he watched her figure out money from scratch. He started reading every statement, line by line, because he needed to understand exactly where things went. Not because he had a plan, because he needed to feel less afraid. That habit turned into a 763 before he had ever heard the word FICO in a context that meant anything real to him. The score was a side effect of paying attention, and the mortgage rate was a side effect of the score, and the house was a side effect of the rate. There is a threshold in the FICO system that most people never hear called by its name, and that threshold is $760. At $760, something changes. Not dramatically, and not all at once, but the mortgage lender's tone is different, and the rate sheet is a different piece of paper. Based on verified rate data, the gap in total interest paid on a standard 30-year mortgage between a borrower at 620 and a borrower at 760 is roughly $70,000. Not in one payment, and not in 1 year, but across 30 years of identical monthly obligations on the same house at the same price. One person pays approximately $70,000 more because of where they stood on a scale the day they signed their name on the closing documents. That is not a statistic you are supposed to feel in the abstract. It is a number that lives in the gap between two people at the same table. Same city, same housing market, same loan officer, same dream. Two fundamentally different financial realities attached to the same front door key. The crossing, the moment the score moves from fair into good, and then into very good, and finally into the exceptional range above 800, does not feel like a celebration. There is no notification. There is no moment where someone calls to say the tax has been lifted. You just open the rate sheet, and the number is different. You call about a car loan, and the person on the phone does not pause before giving you the rate. And the pause was what you always felt before. The apartment manager calls you back instead of asking for the additional deposit, and you realize only later what that phone call meant in dollars. The absence of a surcharge does not feel like anything until you remember what it felt like to pay the surcharge every month without knowing its name. The people in the exceptional tier, scores above 800, mostly do not think about their credit score, and that is almost funny in a quiet way. Not because they are casual about money, but because the behavior that produces an exceptional score, practiced long enough, becomes automatic and invisible to the person doing it. They pay in full every month. They keep old accounts open. They do not apply for things they do not need. And the score is just a receipt. The perfect 850 changes almost nothing that a 780 does not already unlock. And most lenders treat the top of the range as a single tier. The rate at 820 is the same rate at 790. And the mortgage officer does not care whether you are at 811 or 849. What they care about is which side of the threshold you are standing on the morning you walk in and ask them to lend you money. The score you are chasing is not 850. It is the score that moves you to the other side of the line where the tax stops. The score was never the destination. The behavior was the actual wealth move, and the score was only ever the receipt that showed up later. This is where the Sunday night number comes back. $524 on a white screen in a room that smells like the end of the week. That number is sitting inside a system you were never handed the manual for, and school gave you nothing, and your parents gave you what they knew. What they knew was not enough, because it was not built for the world you are trying to build in. And that is not anyone's fault. The number on that screen is not a verdict. It is a price tag. And price tags reflect where you are standing right now, not where you end up. Your 580 cost you $74,000 more than his 760. Not because you made worse choices, but because you started with a different number. What changes is not the number first. What changes is what you know about what the number costs. And that knowledge is worth something, immediate and real. You are going to go back to that app. You are going to see a number that may still feel uncomfortable, still feel like evidence of something unfixed. And this time, instead of putting the phone face down, you are going to understand exactly what that number is taxing and where the tax goes. Every month you carry a balance at the wrong rate, there is a dollar amount attached. Not a concept, not a lesson, an actual dollar amount. Every lease you sign, every loan approved with a polite smile and a rate that is technically legal, there is a number tracing back to your 3 digits. The tax lifts quietly, not all at once and not in a moment, but in 12 months of statements that never miss, and a balance that slowly stops growing. In an old account left open because you finally understood what it was worth to a lender reading a file with your name on the front. One morning, the rate is different. One afternoon, the deposit is the standard deposit. One closing table where the number works instead of costing extra. That is the crossing, and you will probably not notice it the day it happens, because it does not arrive with a ceremony or a notification. But somewhere in a room quieter than this one, with a phone in your hand and a number on the screen, you will know it happened.